So when you invest in a company, you are essentially buying their shares or stock. That word can be used interchangeably. But there are different types of stocks. So first we have the common stock. Now, according to Investopedia, common shares is essentially a type of ownership in a corporation, signifying a stake in the company's assets and profits. As a shareholder, this position makes you a part owner of the business. Now, this doesn't mean you actually own the physical assets like chairs or computers that are owned by the corporation. Instead, as a shareholder, you own a residual claim to the company's profits and assets, which means you're entitled to what's left over after their obligations are met. So essentially, when you open up your brokerage account and you buy shares of, let's just say, Apple or Microsoft, you are now purchasing common stock, which gives you claim to a portion of the company's profit. So some characteristics of common stock: you get equity ownership of a company. It's tradable on public exchanges. So that means when the market is open, you are able to sell or buy shares of whatever company you're interested in. Owning common stock typically gives you, the shareholder, voting rights. There are different things that companies vote on, the board of directors, and different things that you could have an input on as a shareholder. Also, remember, there is no guarantee for dividends. So be mindful, not every company pays a dividend to shareholders. You have to do a little bit more research to understand whether or not the asset that you own, whether it pays you a dividend or not. Another type of stock is what we call preferred stock. Preferred stockholders hold a priority claim to dividend and asset distribution compared to common stockholders. Now, in order for you to have preferred stock, typically you would have to be invited from someone within the company, someone who's an insider. That is not something that is available to everyone. But here are some features of being a preferred stockholder. Obviously, you get equity ownership of a company. It's also tradable on public exchanges. But the difference is preferred stockholders have the rights to dividends and must be paid before common stockholders. Preferred stockholders typically have no voting rights. And in the worst case scenario, if one of your investments or a company that you invested in goes bankrupt, well, preferred stockholders receive better treatment during liquidation when the company is selling off their assets so that they could return some value back to the original shareholders.